This is a confidential executive report prepared by an industry analyst. The findings presented here are based on an in-depth analysis of over 250 biopharmaceutical service provider acquisitions between 2020 and 2025, totaling over $100 billion in transaction value. The report uncovers emerging trends, value drivers, and challenges facing this sector after years of unprecedented consolidation driven by private equity pay. It examines the key factors influencing deal flow, assesses the strategic advantages and risks of pay ownership, and explores the impact on market dynamics and competition. Let's start with the big question. Why have private equity firms been targeting contract research organizations, cross and contract development and manufacturing organizations (CDMOs? And what do real-world examples teach us? Well, there are 4 core factors: predictable revenue, highly fragmented market, premium on specialization, and low binary risk. Let's look at some concrete examples. In 2021, Biopharma, a specialty CDMO focusing on active pharmaceutical ingredients, was acquired by 𝗕𝗏𝗡 Capital Partners. At acquisition, Biopharma's contracts with large pharma customers provided multi-year service agreements that produced around 80% of revenues on fixed, recurring manufacturing fees. This stability aligned with Pay's preference for predictable returns. After closing the deal, 𝗕𝗏𝗡 worked with Biopharma management to refine operational KPIs, driving margin expansion. Another example is GTCR's late 2022 acquisition of a controlling stake in Biopharma, a mid-sized bioanalytical CRO. GTCR immediately rolled up to smaller regional labs, leveraging standardized SOPs and shared procurement. This move consolidated the market and drove a 400 basis point increase in EBITDA margins within 12 months. Looking ahead, let us dive into the key investment trends observed between 2020 and 2025. One concise example illustrates a broader trend during this period. In 2021, Carlyle Group acquired Paragon Bioservices, a small biologics CDMO based in Baltimore. Around the same time, they identified 𝗕𝗥𝗓𝗡 Biologics, a subsidiary of 𝗕𝗥𝗓𝗡 with operations in the U.S. focused on fill-finish services. Recognizing an opportunity, Carlyle merged the two entities, creating Paragon 𝗕𝗥𝗓𝗡 Biosciences. Within 6 months, the company achieved full-service biologics CDMO status from mammalian cell line development through fill-finish, establishing a solid foundation for future growth. This approach exemplifies the buy and build model, a hallmark of Pay activity in the sector since 2020. Now let's review the key transactions from 2020 to 2025, their impact, and estimated returns. First, we have Catalent. In 2024, Catalent was acquired by Novo Holdings for $16.5 billion. The estimated internal rate of return (IRR) is around 18 to 22%. This deal cemented Catalent's leadership in biologics fill-finish and cell therapy capacity while opening doors to Novo's expansive network in the biopharma space. Estimated deal synergies reached approximately $400 million annual EBITDA. Next is Syneos Health. In 2023, Syneos Health was acquired by Elliott, Patient Square, and Veritas for $7.1 billion. The estimated IRR is around 20 to 25%. This transaction reinforced Syneos' integrated clinical and commercialization platform with anticipated $150 million annual cost synergies. Then we have Baxter Biopharma to Simtra. In 2023, Baxter Biopharma was acquired by Advent International and Warburg Pincus for $4.25 billion. The estimated IRR is 17 to 21%. This deal separated underperforming CDMO units from Baxter, which focused on its core businesses. The newly branded Simtra achieved approximately $80 million in lean efficiency savings within 18 months post-acquisition. Parexel. In 2021, Parexel was acquired by EQT and Goldman Sachs for $8.5 billion. The estimated IRR is over 25%, The deal leveraged Parexel's decentralized trial platform and data analytics IP to realize $200 million run rate margin expansion by 2024. Finally, PPD. In 2021, PPD was acquired by 𝗘𝗏𝗪𝗛𝗡. The company went through a significant turnaround before being sold to Thermo Fisher for $17.4 billion. The estimated ROI exceeded 30%. This demonstrated a powerful roll-up then exit strategy generating over $2 billion in EBITDA uplift via multiple tuck-ins before sale. With the understanding that PE firms have reshaped the sector, let's analyze the strategic advantages of payback CROs and CDMOs from 2020 to 2025. The top 5 pay sponsors by deal count and value are Carlyle Group, Advent International, EQT Partners, 𝗣𝗥𝗜𝗩𝗛𝗡. These firms are evaluated on a scale of 1 to 5 on 4 key advantages that contribute to outperformance. Firstly, capital acceleration. The ability to rapidly invest in infrastructure and tech to boost service offerings and drive growth is scored highest for Carlyle and EQT, both known for investing heavily in tech-driven transformations. Secondly, operational efficiency. Initiatives like lean process deployment, standardization, and shared services are prioritized by all 5 firms, aiming to maximize margin improvement and KPI achievement. However, Carlyle and Advent stand out by executing rigorous operational turnarounds alongside growth initiatives. Thirdly, global platform scale. All 5 demonstrate a strong focus on cross-border integration, benefiting from local expertise within a global context. Notably, EQT, 𝗣𝗥𝗜𝗪𝗛𝗡 have consistently built pan-regional platforms. Lastly, tech-first innovation. While all firms recognize the importance of tech adoption, EQT, Carlyle, and 𝗣𝗥𝗜𝗪𝗛𝗡 have distinguished themselves by driving AI, automation, and data-driven transformations, yielding tangible service premiums and differentiation. In addition to the advantages of pay ownership, it's equally important to understand the emerging challenges. For key issues are identified and quantified by approximate annual economic value at risk ever for a typical $1.5 billion platform. Strategic short-termism. Underinvestment in long-term capabilities risks future growth and market share loss. Estimated ever $120 million per year. Quality risks. Cost-cutting and integration efforts may compromise compliance or quality control QC processes, jeopardizing FDA remediation and client loss. Estimated ever $90 million per year. Cultural disruption. Leadership turnover and operational shifts can erode employee morale, leading to attrition of specialized staff. Estimated ever $45 million per year. Reduced market diversity. Consolidation may reduce competition, leading to client pushback or insourcing. Estimated ever $75 million per year. Now let's explore the implications for the sector. Private equity dominance has driven for major shifts that will shape the industry landscape moving forward. Mega platforms now dominate the market. Integrated providers command 60 to 70% of revenue, up from 40% in 2019. Smaller players must specialize or partner to remain competitive. Independents face pressure. Small, single-service labs face margin compression due to rising labor costs. Many will consolidate or exit the market. EBITDA margins for non-pay-backed independents may fall below 10% versus 18 to 22% for those backed by private equity. Talent becomes key differentiator. Specialized talent commands salaries that are about 25% higher than standard rates. Non-pay-backed companies struggle to offer competitive compensation packages. Lastly, innovation drives success. Proprietary AI platforms generate service premiums of 15 to 20%. A lack of tech investment results in a 10 to 15% pricing disadvantage on new protocols.